Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. We've been talking about retirement plans, 401ks, whether you have a 403b, whether you have a thrift savings plan for you that are in the military or federal employees. Whatever type of plan you have in which you get to choose what your investment options are. And again, this can apply to IRAs, Roth IRAs, traditional, doesn't matter, SEP IRAs, it all works the same. Asset allocation is going to be the biggest determinant of what kind of return you're going to get, and as well as the risk and volatility in your funds and the possibility, if you're truly diversified, if you've got a portfolio like my clients where they've got 15, 16,000 different stocks in their portfolio, they're not going to have to worry. 15, 16,000 companies aren't going to go out of business, right? But if you've got a handful of stocks and you think you're diversified, you're taking on a much, much greater risk. All right, here's something else to think about with your 401ks. Failure to offer less expensive options. This is one of the things that we see. So under federal law, any company providing a retirement plan must create a prudent plan in your best interest. And since there's fierce competition, we're seeing fees coming down. You can find great funds that cover most world markets for half the fees of say about a 1% is what we're seeing typically in a 401k. And that's just the fund fee. There's other fees that you can get into. And any fund that offers 12b1 for wrap or sales charges are of course completely unnecessary. You got to really watch for that. And when you're investing in mutual funds, understanding in particular on the active side, if you're going through most broker-dealers out there, it doesn't matter which one it is, one of the things you're going to see is that these upfront sales charges can be 4.5%, 5.5%, quite high, that comes out up front off of your money. Okay, it's going to take a while to make that up, isn't it? All right, and not to mention the other ongoing fees. Company stock in a 401k is another area. Think of WorldCom and Enron and what happened for the poor employees there that lost most, if not all, their savings because they had most of it in that company's stock. So that's another area that you would want to avoid. All right, one of the things I'm going to share with you again, we're going to look at, when we talk about asset allocation, I'm going to jump into giving you now some tips on how to do that. I'll show you the academic research. So let's first start. This is called the 3 worlds of investing. I've shared this with you before. When we're looking at how to invest, okay, the first world is that of safety and protection. Things like your savings, your checking, money markets, bank CDs. You can get government-issued things like savings bonds and treasuries. Insurance companies have what are called fixed annuities. All of these have this in common, and please understand, by the way, on annuities, I'll cover this in a little more in depth, but there's a huge difference in annuities between, say, fixed annuities and what are called variable annuities. And the majority, about 75% are variable, that are in the marketplace are variable, and that's a totally different type of annuity, and I'll share that with you, than the fixed annuity. A fixed annuity, much like a bank CD, is going to give you your principal is guaranteed. You're not going to lose any money. You're going to get some kind of an interest guaranteed. An example would be right now, typically, if you're looking at say a 3-year CD, you're probably looking at somewhere around 1%, give or take, maybe 1.25%. If you look at a 3-year fixed annuity right now, they're paying about 2%. If you look at a 5-year CD, you might get up around 2%, and on the fixed annuity side, around 3%. And what's the, principal guaranteed, interest guaranteed, penalties for early withdrawal, so don't take out a 5-year CD if you plan on buying a car with the money in 2 years, right? That's the way that goes. So we want to make sure we understand what we're doing and why we're doing it. Next is understanding, if you see the historic rates, though, on this, it's safe and it's protected, and it would be great if we could keep everything in there. The problem is the rate of return is so low that it doesn't stay ahead of inflation and taxes. And there's the rub. All right, so how do we get ahead of inflation and taxes? Because it's not what we're earning, right? It's got to stay ahead of if the cost of the things that we buy keep going up, medical costs as an example, groceries, all of that, and our money's not earning enough to stay up, we're going to find that we're spending more and more money to buy the same things, and over a 10-year period, that could be huge. You could be looking at 30% more that you're going to have. So an example would be, if it costs you $60,000 a year to buy the things that you maintain your standard of living now, in about 10 years it's going to be $75,000 to $80,000 to buy those same things. All right, so to stay ahead of inflation and taxes, we then look at one of the things a lot of people do is the stock market, right? Stocks, bonds, mutual funds that are made up, of course, of stocks and bonds. You have things that are called exchange-traded funds. These are similar to mutual funds that buy a basket of stocks and or bonds that are put together. They just trade differently. REITs, real estate investment trusts, I would avoid those, by the way, and I can cover that with you a little bit. And then, of course, variable annuities you definitely want to avoid. And one of the reasons for that is the higher fees. I met with a new client just yesterday, and we're going over the variable annuity she has, and it's averaging over a period in the she's been in it, let's say, I think when we looked at this one, it was around 5 years. So over that 5-year period, had she been invested in the market, she would have received somewhere around, you know, in again, a 60-40 type portfolio, she would have received somewhere around 8% a year. Instead, what she received was about 3% a year. And that had a lot to do with these high fees. Okay, when you're spending, when you've got 2 to 3%, or in some I've seen even as high as 4 and 5% a year in fees, it's almost impossible to overcome those fees and get any type of return. But if you go in with the proper asset allocation and low-cost, passively managed funds, now you can look at a return that'll keep you ahead of inflation and taxes over the long term. So this is where now, but keep in mind, no guarantees, right? Your principal's not guaranteed here, certainly no interest guaranteed, and the key is needing time. You need to be able to leave that money alone when you put it in the market. So if you're going to invest in the stock market, you need to be thinking in terms of the time frame. Asset allocation comes in here again. More stocks that you have, the longer the time frame you want to commit to when it comes to investing in the market. And when we're investing for retirement, of course, we're looking at that long-term goal as well. All right, so 10-year rolling averages is what it's referred to. And if you, with 10-year rolling averages, you're looking at about a 95% chance of success if you're in for at least 10 years. In the portfolios that I utilize with my clients, we've never had a 5-year period that didn't give us a positive return. So these are some things to look at, and it has to do, again, asset allocation. Finally, in that third world in the middle, we have index CDs, we have index annuities. Here again, we start with all the guarantees now. These are fixed annuities, so they start with all the same guarantees where your principal's guaranteed. You may have some kind of interest guarantee. Of course, penalties for early withdrawal, so make sure that you're okay with the terms that you're going to fit your financial plan. This is why I say a personalized plan. When I'm talking about these things, this is not meant that you should just go out and say, oh, I'm going to go do this. No, no, no. All right? There's a right way to go about it. I'll talk about it in a minute, but let me finish. So here's a way, again, that you can stay ahead of inflation and taxes. Historically, they've worked for that. They have a link to the stock market through some type of an index, like an S&P 500 index. We've had some other indexes I'll share, like the Schiller Index, the Merrill Lynch Index. There's a J.P. Morgan Mosaic Index. So there are a number of ways. Barclays Aggregate Bond Index, right? There's a lot of them. All right, so we can get rid of that slide. And I'm going to share with you, I mentioned about Nobel Prize winning research that's behind how to do asset allocation. Before I go there, let me remind you, when I'm talking about these things with you, okay, understand this very important fact. This is general information. It's meant to help you understand how these things work, but it's not actionable for you, okay? Meaning that for you to take these actions, you need to make sure that it fits your individual situation, and that's where a little more work comes into play. All right. In fact, I'm going to make it easy for 10 of you, because for the first 10 callers to my office this morning at 615-376-5325, I'll offer up a comprehensive plan in which I will help you navigate this and develop a personalized plan for you. I'll help you determine what's the asset allocation model that you need to attain your goals, all right? To determine what your needed rate of return is how we go about that. We look at what you have for income, expenses, assets, liability. What does in the future? Are you going to have a pension, Social Security? Are you going to have other income, say from real estate or other sources? All of that we're going to take into consideration, and I'll be able to show you your financial future based on the things you're doing today, so we can see the risk. Wouldn't you like to? I mean, if the things you're doing, wouldn't you really like to know that that's going to get you where you want to be? Wouldn't that be very valuable to you? No cost, 615-376-5325. I can show you your financial future based on the things you're doing. I can show you some of the risks and minefields that may be in that current plan, and show you how you can in fact make some improvements to it to attain your goals, all right? Maintain your standard of living and quality of life no matter how long you live. And when you come to the office, now when you call, by the way, Debbie's standing by. She'll get your information. She'll send you out a checklist of things to bring to the appointment. And with that, we'll be able to give the plan for you. And whether it's one visit or two visits, however long it takes, I want you to have that comprehensive plan that you're looking for. When you come in, I'll give you a copy of my book, 7 Steps to Financial Freedom in Retirement as well. And it covers a lot of the things that it's basically the planning that I've done over the last 26 plus years now. Working with clients, I talk about these case studies and I talk about the same strategies there. These are proven strategies. And we're always looking to improve, but we know we go with what works as well. We don't jump around unless we find something that we know is going to be better. All right, so let's go back now to this asset allocation. Look at the Markowitz Efficient Frontier. Dr. Harry Markowitz won the Nobel Prize back in 1990, and basically what he found was that if you blend together certain asset categories that have a negative correlation, like stocks and bonds as an example, you can in fact reduce your volatility. So that's what you're seeing. Along the line, you'll see conservative portfolio, moderate portfolio. What that means is how much is the stock to bonds. So that moderate portfolio, for example, is about 50-50 stocks to bonds. Along the bottom, the right, that's showing standard deviation. That's the risk measure in your portfolio. You see the S&P 500 index that I mentioned, which outperforms 90% of actively managed equity mutual funds. And it does great as far as return. Over the last 40 plus years, it's averaged over 10%. But its standard deviation at 18 that's a lot of volatility. That's a lot of risk. A moderate portfolio gave us a very similar return, but with half that risk. So that's how we're able to use that. Now, if you look at the next chart, you'll see asset allocation, what that would look like, how the smart money invests. These are the kind of portfolios that we're talking about as far as design goes. So this now, after Dr. Markowitz, we had Dr. Fama, who won a Nobel Prize a couple of years ago. Let's go to the next slide and show how the smart money invests. This is Dr. Fama's formula. It's known as the 3-factor model: asset allocation, diversity to minimize risk. Let's go ahead to the next slide. There we go. All right, so if you look at this one, this portfolio at 50-50, and there's asset allocation, and it breaks it down, 16,000 different companies, 21 distinct asset categories, 45 total countries. All right. So that shows you the model. Next, I'll get into comparing returns over, say, this century, if you will, from 2000 forward, and then share with you some other strategies that we're using now, some new momentum strategies that we can use with the portfolios as a hedge to help us, and when the market's down, to help protect us and even make money when the market's losing money. So we'd have, when the market's doing well, we'll have a strategy for that, and then we'll have another strategy blended with it that will help us when the market's down make up that difference and smooth out that volatility even more. All right, so I'll show you that when we come back. Join me here. I'll be right back on the Retirement Report.